Hello friends, last week in my video, I put forth the possibility of a pre-budget run-up. Historically, budgets are seen to be preceded by a bump up in market prices because traders expect governments to announce SOPs, reforms, freebies in the budget. And the budget of 2023 is very different because it is the final full budget before the elections of 2024. Now, what has happened last week is that risk appetite has gone up. Why am I saying that? And I will provide you enough in statistical evidence to say why retail risk appetite has gone up. But will prices rise along with the retail risk appetite? That's what this video will tackle. Let's dive right in, and on your window right now is the market roundup window, and what we are seeing is that the broader based Nifty 50 led the charge upwards. The US dollar index, the Dixie, fell once again, and that is what basically provided a relief rally in emerging markets, including India. Gold rose and silver reacted on profit taking. The prices of natural gas continued to fall, as I have been advocating in our free Telegram channel, that natural gas prices will continue to underperform gold and underperform crude oil, and operator interest will now shift from natural gas to crude oil. Continue to monitor our Telegram channel for more guidance. The USD INR also fell in tandem with the Dixie, which is the dollar against the rupee, which is another reason why our markets rallied. NSE unfortunately saw a mild decline in market capitalization, and we are going to see more of that in the LWTD and impetus indicators. The 10-year benchmark bond yields rose. That means bond prices fell, but for which the bank Nifty's gains would have been even bigger. US markets were a mixed bag because the beaten down technology index, the Nasdaq, was the only index out of the three that we cover here which rose. The Dow and the broadest of them all, S&P 500 index, managed to log gains, losses, unfortunately. Coming to our in-house indicators, the MWPL continued to rise, and in the third week after expiry of the December series, we are now at 31.53. Note how in the third week after the November series, we were at 33.48. So risk appetite in terms of buy and hold traders was marginally off. Not surprising because the prices are not moving as traders wanted. Now for the turnover of the index futures vis-a-vis stock futures, these are cumulative 3 series, that is January, February, March. What we are seeing is that index futures turnover fell and stock futures turnover rose. Now this is the first sign that the risk appetite has grown, because it takes more money to dabble in stock futures by way of span margins. The volatility in stock futures is higher as compared to index futures. And when turnover goes up, that tells you that the retail guys are showing greater risk appetite. Now for the advanced decline ratio, what you are seeing is that the average of all 5 trading sessions of the week, the advanced decline ratio was down to 0.79. That means for every 79 gainers, there were 100 losers. Not a very good sign. Not a very good sign at all. This ratio needs to perk up. Now, the basis. Basis is nothing but the premium or discount prevalent in futures compared to spot. The basis is the lowest in many weeks. I would say more than 15 weeks, 14 to 15 weeks. Now, that tells you that buy and hold 2 marshmallow traders are basically showing signs of caution. They're not rolling over as many trades as they should be, which is why MWPL is down. Do remember, MWPL is not as high as it was barely a month ago. Now for impetus, this is an in-house exclusive indicator you won't find anywhere on the internet. You've been trusting it for almost 2 years now. The impetus is down across both the indices, which tells you that last week's rally was on poor momentum. Conviction levels were mildly lower, which is why the impetus is down. And the Nifty impetus, mind you, is at a 20-week low. So we need basically more proactive and more aggressive buying to come in if the markets were to rise. The LWTD indicator, one of the latest indicators that I've started sharing with you, exclusively developed by our in-house statistical trading model, the IBEX, remained flat for the third week in a row, that too below zero. So it's at minus 0.11, more or less unchanged. Whereas the Nifty's percentage gain loss has also come down a bit as compared to the week prior. So buying support on declines is likely to be relatively muted. So the LWTD is telling you that the bulls may not really offer wholesale buying support. That needs to change. Now, this is an indicator that I upload on my social media accounts, especially our Telegram channel, every single day. So do connect with me there, please. Our in-house indicators done. I now come to the bond market, which has seen bond yields rising a bit. That means bond prices have come down a little because risk appetite for equities has increased and bond buying has tapered off a little bit. These are expectations of lower inflation, or at least inflation flatlining, currency pressures declining, which is why there is selling in bonds. This is not to say that your laddering process, which I have been telling you across my social media accounts, need to cease. Not at all. But like I told you in my recent videos, I would wait for slightly higher yields before I write out my next check again. And I'm in no hurry at all. I'll be updating my Telegram channel very soon. It's a free channel. Please join my channel there. About an excellent investment avenue, sovereign backed risk-free investment avenue where the yields have just gone up. And I'm open to the idea of writing a check for that avenue. So do stay with me there. Now, coming back to bond yields, would I buy bonds? Yes, I don't really mind if the yield is coming close to 8.0%. Not exactly reaching there, even coming close. But right now, it's way off the mark. It's 7.34, 7.35. So I'm waiting and lining up my ducks, keeping the powder dry. Like I said, I'll update something on my Telegram channel soon. Friends, the bond market's done. I now come to the Bank Nifty, which gained 0.32% on a week-on-week basis. As you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions, and it's respecting the 41,840 levels very, very seriously. That's a swing high logged in September of 2022. It's also a double bottom now because we've seen the price being tested in December 2022 and now in Jan 23. As long as the bulls are able to defend 41,840 and keep the Bank Nifty trading above the 20-day moving average, which is a month-long holding on cost of an average bull, I think the bulls still have a chance. This is presently a time-wise correction. Take a look at the weekly chart of the Bank Nifty. It's trading fairly comfortably above the 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. The body still remains contained within the big red candle logged a fortnight ago. But it's a hammer. And the closing is in the upper end of the week's range. Now that makes this week gone by slightly better as to the prior week, where the closing and the open was somewhere close to the middle of the week's range. So week on week, there has been marginal improvement, and that is something in conjunction to the turnover figures, which I told you, is telling me that risk appetite went up a little bit. Now, in the week before last, this index was at number 4 on our statistical beta list, which we maintain in-house of the most volatile counters. It fell 4 notches to number 8, which is always welcome because lower volatility means lesser challenge for retail traders. Last week, we advocated a range between 43,750 on the upside and 40,975 on the downside, which held perfectly well. In the coming week, I expect a range between 43,850 on the upside and 41,150 on the downside. I continue to advocate trading light, and do remember the coming week is a special one because 26th of January is a holiday on account of Republic Day and it's an expiry week. So volatility might just be high, price discovery mechanism might be a little patchy. Ingress and egress, which is entry and exit, order fills on entry and exit may be patchy, and the bid and offer spreads may be wider. So let's be careful out there. Friends, the Bank Nifty done. I now come to the Nifty 50, which rose on 2 out of 5 trading sessions, but the gains were good enough to basically result in a 0.40% advance on a week-on-week basis, as you can see on the daily chart on your screen. What is apparent is that the price is trading below its 20-day moving average, which is a month-long holding on cost of an average bull. The average itself is sliding lower, which means the immediate outlook is marginally nervous. Also note how the 18,115 level, which I have marked with a thick blue trend line, is proving to be a hurdle. It's a previous swing high and it's proving to be a hurdle. Number one, you want the bulls to push the Nifty above 18,115 on a sustained closing basis, which means the Nifty should not close below 18,115 and ideally go past the 18,350 levels. That's when I would say I might venture out a high risk intraday buy. Coming to the weekly chart, what we are seeing is price is above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook still remains positive. It still remains a dragonfly doji. The opening and closing is close to each other and both are in the center, the median point of the weekly range. So there was indecision. There was an almost equal force between buyers and sellers. What we need to do is close above the 18,350 odd levels to basically entice the fence sitters, traders who are still sitting undecided as to what they should do, to entice them to come back on the buy side. Friends, in the week before last, this index was at number 11 on our statistical beta list, the highest volatile counters. It slipped 3 notches to number 14. Always welcome to see volatility fall because then the retail trader doesn't get whipsawed as often. Last week, I advocated a range between 18,450 on the upside and 17,475 on the downside, which held perfectly well. In the coming week, I expect a range between 18,500 on the upside and 17,550 on the downside. Like I said in the Bank Nifty segment, I think you should trade light for the simple reason that it's a 4-session week and that too of a monthly expiry. So a price discovery mechanism I do see is a little patchy out there. Now for the segment which I have started sharing off late about the retail risk appetite footprint and why I said risk appetite is back, but will prices follow? Take a look at the chart, daily chart on your screen of the Nifty futures as well as the contribution by the index and stock futures and options as a total percentage of the turnover transacted in the F&O space. The sky blue line is the stock options turnover, which is at a period high. So that tells you, in spite of higher volatility, in spite of higher cost involved in trading stock options compared to index options, retail traders have enhanced their footprints. So they're willing to write out bigger checks and they're willing to take bigger volatility risk. Now for the olive green line, which is the stock futures turnover contribution, is also at a period high. That means risk appetite has gone up. Do remember, individual stock futures have volatility intraday range between 3 to 3.5% per day, whereas indices are anything between 1.5% to 2.25%. The fact that turnover in index stock futures and stock options is higher tells you that retail traders are writing out bigger checks. If that is not a sign of higher risk appetite, I don't know what is. Now take a look at the next chart where index options turnover is depicted along with the Nifty futures. It's collapsed to a period low. This happens when traders are saying, hey, the index is a very safe trade, but I would rather write out a bigger check and take higher risk in individual stocks. So risk appetite is definitely back. Now, friends, when will the markets rise? Markets will rise when the 4 index heavyweights, the heaviest weighted stocks, Reliance Industries, HDFC Bank, Infosys and ICICI Bank rally in tandem. Now let's take a case-by-case view of what's happening. On a weekly chart of each counter, Reliance is seen sliding. It's recently announced its numbers, so we need the price to perk up immediately as the highest weighted stock in the Nifty. This stock has the ability to swing the index in its direction. HDFC Bank was rising. Again, people loved the numbers of HDFC Bank, and this is something that I talked about in my video last week as to what I would do. I said I would wait for HDFC Bank's numbers to get digested by the market, and they were digested well. Infosys rose on the back of a rising Nasdaq 100 index. Do remember, out of the 3 US indices I covered in the roundup window, the Nasdaq was the only gainer. So there could be a relief rally in technology stocks. And the fourth one, ICICI Bank, continues to remain under pressure on the weekly chart. Number one, all these 4 counters must rise. Number 2, the Nifty must rise above the 18,350 level. Number 3, what I would want is price, volume and open interest to rise in tandem along with higher impetus if the bulls are able to sustain the upthrust. That is when the markets will make a conclusive, sustainable upthrust. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks that have lost the most amount of impetus on Friday, where you take the biggest amount of exposure, wait for small price moves, that's for scalpers, and 5 stocks that have gained the most amount of impetus, where you take small exposure and wait for large price moves. These are for swing traders. Remember, this list is valid only for Monday, Tuesday through Friday. I update this list for free in our free Telegram channel. Do connect with me there. So the list of impetus gainers, where you take small exposure, wait for large price moves, is led by Canfin Homes, followed by Manappuram Finance, followed by ICICI General Insurance, Torrent Pharma and Indus Tower. Impetus losers for the day, where you take big exposure, wait for small price moves, led by Mahindra, followed by Bajaj Finance, and then Idea, ICICI Bank and Trend. Friends, before I say goodbye in this video, a humble reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment section, do let me know how my videos are helping you take better informed trading and investment decisions. Also, help me reach out to fellow like-minded smart traders like yourselves by sharing my videos across social media platforms. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Bye-bye.